there's a record commitment by U.S. households to equities right now. According to the Fed data, U.S. households now allocate 45% of their financial assets to stocks, which is 16% higher than at the peak of the dot-com mania. But what's interesting is that investors in the aggregate tend to herd. In other words, when the trend goes up, they get more bullish in a patterned way, and the trend goes down, they get more bearish. And you can see when the market was in a correction back in the financial crisis of 2007, 2009, people weren't buying stocks, they were selling stocks, okay? And as the trend moved to the upside, we now have a record commitment by U.S. households. So the public is involved in the stock market to a record degree. But not only is the public involved in the market to a record degree, but the pros are similarly smitten with stocks, okay? This is the State Street Institutional Investors Exposure to Equities. We ran this in September in our newsletter, the Elliott Wave Financial Forecast, and they've recently moved up their exposure to the highest level since November of 2007. Now, you remember what happened in November, October of 2007. Market was topping out, and we started the biggest bear market since the 1930s. So we have the public with record commitments. We have the pros who are committed to the same degree as they were back in 2007. We also have pension funds committed to the market. Now, what's interesting about this, if you notice the red line at the bottom, that's their allocation to cash. It dipped down to 2.1% September of last year, and it stayed at that level and has now dipped even lower now. But at the same time, if you look at the blue line, they've upped their commitment to stocks to over 85%, which is a record high. So we have the public, we have the pros, and we have the pension funds all committed to the market to an unprecedented degree. Here's another way of looking at it. This is pension fund cash allocation, which is the blue line, and then mutual fund cash allocation as a percentage of total assets, which is the red line. So mutual funds are committed to the market also. Not only that, but corporations are committing money to the market at an unprecedented level. We first published this chart in our newsletter of April 2022, and it shows that companies tend to buy back their shares to the greatest degree commensurate with market highs. In other words, they're buying, but when they spike to all-time records, it usually coincides approximately with a market making a high. So we have institutions, we have companies, we have pension funds, we have the public, but there's another group that's making a record commitment to stocks, and that's foreigners. In late 2021 and early 2022, which was their last record high, remember what the stock market was doing was making a top that led to a big decline in the NASDAQ, about 28% in the S&P 500, and the Dow was down about 22%. Foreigners tend to commit the greatest amount of money commensurate with stock market highs. And we could show that this doesn't look like much on the chart, but at the time, these were all record highs. They committed it at the dot-com peak in 2000, at the start of the Great Credit Crisis in October 2007. They committed a lot in 2022, and now they're at record levels now. And here's something else that's interesting. I'll get to it at the end, and we'll talk about it. Not only are institutions and investors and households and the retail and foreigners committing money to the market at record degrees, but the big difference between those other periods and now is they're doing it with record amounts of margin debt. Okay, margin debt hit 1.13 trillion in September. That was a new record that pushed 20.8% past the high points at the end of the last major market moves in November 2021 when the NASDAQ made a high. So we have record amounts of money being invested, and not only that, but record amounts using leverage, using borrowed money. Now, this conventional measure of margin debt is at scary heights right now, but I think it pales in comparison to the new forms of debt that are being employed by these financial engineers. For example, this is a portion of equity exchange traded funds that use leverage. And it shows just an explosion in the percentage up to recently to 33%, which is 3 times the prior peak of the last high, which is in 2022. So we have margin debt, but now we have equity exchange traded funds that are using leverage. But it's not only that, it's the total number of exchange traded funds that are now employing leverage to try to goose their returns. It's up to 701. About 5 years ago, the total number of leveraged equity ETF was around 200. So we've had about a 250% increase over the last 5 years. And of course, if we're going to have a total number of leveraged equity ETFs in existence, you would expect that the amount of assets using leverage in equity ETFs has increased too. And of course, you can see that it was about 20 to 30 billion about 5 years ago. It's now pushing 130 billion, and that's a 333% increase over the prior record. And the retail public is getting involved, as you know, and they're doing it through options. Not only the option market, but zero-day options. In other words, options that are expiring the same day that they're issued. It's kind of like day trading, but for option traders. And you can see that the amount of 0 day till expiration options makes up right now 62% of total option volume, which is a record high. So we've got this major commitment to the market right now. People love stocks. All right. We have one major problem though. And that is, well, it's more than one major problem, but the major problem from the public's view is that we are now at record valuations. Okay. This measure was published in Bloomberg. We showed it earlier this year, and it's simply a combination of earnings and market cap to GDP and price to book value. And if you notice the big peaks previously in this measure of valuation, they all occurred at major market highs. For the first spike occurred in 1929. Of course, we know what happened then. Market topped out in the fall. We had a big crash, an 89% decline in the Dow. In 1966, we had another big spike and a turn down. And remember, that was when the Nifty 50 were popular, those 50 stocks that all you have to do is buy and hold forever, and they'll always go up, kind of like the AI stocks right now. And of course, in 1999, we had another spike in this valuation measure that coincided with the peak, the dot-com mania. And what's really interesting is that in August of this year, we republished this chart because it went to a new all-time high. So we have record overvaluation looking back through 100 years of history as people are committing the most to the stock market. Now, what's not in that valuation metric is price to sales. This is the S&P 500 price to sales ratio. I kind of like price to sales because in earnings, there's pro forma earnings or operating earnings. You can kind of manipulate earnings, but you can't manipulate sales. Either you have sales or you don't have sales. Well, price to sales ratio, the S&P 500 just went to 3.4. It's a new record high. At the dot-com mania peak, it was 2.1. So we're 62% higher today than we were back then. Again, another major valuation extreme. And what's another interesting valuation extreme is what's called the Buffett indicator. As you know, Warren Buffett came up with this indicator where he took the total stock market capitalization and he looked at it relative to GDP, relative to gross domestic product, because he figured, okay, this is the productive assets of the economy, and we can look at stock market valuations relative to that. He called it the single best measure of whether a market was overvalued or undervalued. So that's the purple line. And as you can see, the dot-com mania, the Buffett indicator, the stock market relative to GDP is 1.5 times. We're now at 2.19 times GDP, 46% higher than we were at the dot-com mania. 106% higher than we were at the peak in 2007. Of course, we know what happened at those previous peaks. We had major bear markets. NASDAQ after the dot-com mania lost 78%. And in 2007, we had the biggest stock market decline since the Great Depression, where the S&P was down 58%. Now, as a corollary to this, I want to just take a look at the yellow line. Now, what the yellow line represents is Bitcoin. Okay, people are saying, well, Bitcoin is now the new value metric. It's now the new long-term metric where you can, it's a store of value. You can buy Bitcoin and you can have long-term value in it. And what we did here is we just overlaid Bitcoin over the stock market relative to GDP. Now, if you notice, the tops and the bottoms are not exact, but they're darn close. And Bitcoin basically trends and reverses with the stock market. Bitcoin is just another vehicle for speculation, and I think this chart proves it right here. And if the market does top out and go down, Bitcoin is going to be right there with it. Okay. Now, one thing Warren Buffett has right now is a record amount of cash. He's like $382 billion. Okay, so Buffett himself doesn't think that there's value in the market. And we ran this earlier. Investors love Buffett and then ignore what he says. All right, so everyone thinks of him as the Oracle of Omaha, probably one of the most astute value investors of our time. He has a record amount of cash, and the question is, what does that mean? Well, you can ignore him, or you can say, well, he's looking at value and he doesn't see it in the market. So the question now is, are there shorter term signs that we think stocks are topping out?